This is Trend Following Radio, where great thinking comes alive. Nobel Prize winners, legendary traders, best-selling authors, and the pros that know what drive us irrational human beings. I am your host, Michael Covel. Not filtered, raw, honest. That's my passion. They're handing out the Nobel Prizes this week. 3 gentlemen got them for their work contributing to the field of economic sciences. Professor Schiller and Professor Fama are the 2 that I'm going to focus on. I don't know the other guy. Schiller has been right at the forefront in the last 20, 30 years talking about bubbles and overreactions in emotions. Behavioral Finance 101. He's not the only economics professor to do this. Vernon Smith, Daniel Kahneman. But it's good to give recognition to somebody that says, look, there are major bubbles out there. There are overreactions and people invest with their emotions. And big market moves happen. Well, that's Robert Schiller. Now, they also gave it to Eugene Fama, who has said that basically the trend following world that I exist in lacks empirical evidence. I noticed on the Business Insider tonight, they had the headline that ran, Nobel Prize winner Eugene Fama explains why you have no chance of beating the market. And it was kind of like a boilerplate article with him smiling with the University of Chicago logos in the background. As you might have guessed, Eugene Fama is all about the markets being efficient. So, for example, Fama doesn't think that the Great Recession really hurt this view of efficiency. He thinks it came out fine. You know, the efficient markets hypothesis was not discredited. And he said, quote, I think it did quite well in this episode. Stock prices typically decline prior to and in a state of recession. This was a particularly severe recession. Prices started to decline in advance of when people recognized that it was a recession and then continued to decline. There was nothing unusual about that. That was exactly what you would expect if markets were efficient, end quote. Well, the guy that wrote this article, he made the comment, he said, nobody could say that Chicago school economists aren't resourceful, especially when it comes to defending their worldview against attack. And what's amazing is the Nobel Committee gives the award to Schiller and Fama. Now, granted, I'm sure there is all kinds of minute detail that I'm frankly not interested in. But the big picture that these 2 men promote, the big picture that these 2 men push, are polar opposite. They're contradictory. Amazingly, the Nobel Committee said they're contradictory. Where does that leave you? That leaves you, my friends, if you're trusting the system, good luck. Good luck trusting the system. Let me move into introducing my guest for today. Nick Atkeson is on the show today. He is a registered investment advisor. Today we are going to talk about his book, Win by Not Losing, a disciplined approach to building and protecting your wealth in the stock market by managing your risk. This is right up my alley. There are so many common themes in Nick's work with my work. This is why I wanted to have him on today. A great conversation. So let me jump right in today, Nick. I did not know what to expect with your book, Win by Not Losing. But it's detailed. There's a lot of stuff going on in there.
Yeah.
I mean, this is the full enchilada. This is a perspective, and I think especially this week where you have the announcement of the new Nobel Prize winners, well-known names to those in finance, Eugene Fama and Robert Shiller.
Yeah.
You seem to be going more towards the Shiller side.
That's exactly right. Yes. So it's interesting. In our book, what we did is we used personal stories of real people dealing with sort of real life issues to talk about, to highlight important fundamentals of active trading. And our thought was that very few people want to read a hardcore finance book. It's just dull for most people. So our thought was, let's talk about people and their stories, and then from that, learn the lessons that we're trying to impart through the book about how to manage money actively. But it is interesting that, as you say, Shiller was one of the first to talk about how at least PE over a long period of time actually was predictive, and that maybe the markets aren't totally random and efficient, and there was some predictive element. And then Campbell at Harvard, and then more recently, this guy Cochran at University of Chicago have done a lot of work looking at the predictive element of stocks and looking, really what we're doing is we're taking the, and this is, I'm kind of going to get deep into it a little bit, but we're taking the present value formula, which has been, most people have been focused on present value equals the sum of the discounted future earnings, and then taking it back by some kind of constant discount rate. And the whole focus has been the discounted earnings. And what we're saying is actually the real focus should be more on the discount rate. The earnings don't change that much. It's the discount rate that's changing a lot. And that's that sort of fear or greed in the investor that's jumping around quite a bit, that's moving stock values way more than expected earnings.
Well, as you say that, as you jump right into a thought process that's perhaps very different than thought, it is very different than the thought process that I've discussed in some of my books. But the one thing that I saw in your writing is that you do go to a very common place, or a very similar places to myself, where you are talking about momentum, you are talking about streaks, you are talking about fear and greed, and you're talking about, and when you're using this word streak, I almost see you using it as the word trend in some ways.
Yes. So it's funny, the original thought was to actually entitle the book Streaks, but the publisher felt that, and actually the book resellers felt that the word streaks isn't searched that much on the internet, and it would be better to have another title. And it turns out, I think that Win by Not Losing is actually a substantially better title. It really says more about what it is we're trying to say simply than the word streaks. But what this book talks about is avoiding major down moves and catching major up moves, participating in bullish markets, avoiding major bearish markets, and using pretty simple price signals to do that reliably.
Let me add something really quick, just kind of a side note about publishers. My publishers did the same thing, and they really don't know what they're talking about. So your title's fine, but your title is Streaks. It wouldn't have made a hill of beans difference whether or not someone searched for it or not. If it's a good book, people will find it, period. And it is a good book. So, publishers are in left field. So, hey, listen, I want to jump in because you mentioned in the very beginning about stories, and I don't want to go through all of the stories in your book, but I think maybe as you say that, and as we start to get kind of deep in the woods and a little bit technical out of the gate, maybe you could tell the story, or at least a part of the story, of Sonny and his idea of to stop playing, and the idea that Vegas has this phrase, the theo. Maybe you could explain that. I think it's a cool story.
Okay, well, so Sonny, I'll bring it into really personal terms for myself, which was that we worked at Montgomery Securities, and we'd sit on the trading floor, or not on the trading floor, but we'd actually come up to the research meeting where, we had actually the largest trading floor outside of Manhattan, and there were about 300 of us on the 6th floor of the Pyramid Building in San Francisco. And then we'd be brought up into the lecture room, I'd call it, and we'd listen to company presentations, and we'd listen to the head of sales talk about what was important to sell that day. But the murmuring among the crowd would be, Rio's going to miss the number. And we go, well, how would you know Rio's going to miss the number? Well, that's because Sonny had visited Rio. And he'd hit him for enough to make him miss the quarterly earnings number.
Rio, for those not familiar with Vegas, would be the Rio Casino.
Yeah, sorry. Yeah, sorry. So anyway, I mean, that was the first step into this. And it was sort of like, no, come on, that's not possible. An individual that I know is not disrupting a publicly traded company's ability to report earnings. But
was he?
Yes. And as we gotten more involved with Sonny and spent some time with him in Vegas, sort of personally witnessing what was going on, it was just it was incredibly impressive and amazingly disciplined. And personally, I don't think I could have engaged in that type of activity. I don't have the
only blackjack, right? Only blackjack.
Only blackjack. I don't have what I call the emotional fortitude to withstand the pressures that he would place himself under. But he was a whale. He was a whale. He was a whale, and but somewhat different. He was just an extremely disciplined whale. I mean, over time, the theory of the casino is the odds are in the favor of the casino. And even if it's only 51%, if you play the game a million times, eventually the casino takes the majority of the winnings. And that's the idea. And so once a whale, starts to walk away from the casino with a substantial amount of winnings, the goal is to invite them back, lure them with bigger and bigger entitlements, maybe trips to Paris, 8,000 square foot suites, all the service you could want. And eventually they'll give all that money back plus some. And with Sonny, he proved that over long periods of time, that wasn't the case. And so eventually what ended up happening was many casinos just got out of the business of providing service to Sonny.
Talk about the word theo, Theo, in the Vegas context. So
theo is the theoretical win ratio. I think that's what we're referring to here in chapter 1.
Right.
And it's funny, I should probably go reread my book. But,
I'm putting you on the spot today.
Yeah, no, you are. You're coming into the details of this, and Sonny had to explain it to me. But basically, I believe it's a theoretical win ratio, and in essence, Sonny is supposed to lose. I was sort of, getting at that, and I'll leave it at that. And he basically, by using again a very disciplined approach, by managing his betting based on the streaks he was encountering in the play. Was consistently winning.
And he would walk away, though. He would, if something happened that went against his approach, his system, he'd walk away.
Yes, and part of what's impressive about that is that there's a piece of it that's sort of I don't know whether you call it a social element, which is he would prepare for days, if not weeks, to come to Vegas with the play structured the way he wanted it, with the guests that he wanted. They'd be flown down in a private jet, they'd stay in a very nice spot, and literally 8 minutes into the visit, he might call off the gambling because it wasn't going his way. And it was that kind of cut-loss discipline that really, really kept him out. He didn't feel a need to put on a show for anyone, including the casino or the friends or anyone else. He stayed very true to his discipline.
And this wasn't a discipline that was kind of an intuitive gut feel. This man had an approach. He knew what his rules were. He knew how much he was willing to lose. He obviously had a very disciplined approach in blackjack, probably not unlike what the MIT guys did. And then he would just say, "That's enough. I'm out."
That's exactly right. And actually, in our book, the book talks about using a very simple method of measuring market, whether the market's in a sustainable intermediate, let's say a sustainable intermediate trend, uptrend or downtrend, using a moving average crossover model. And it's very, very simple. You can execute it in the house. You can do it yourself. You really don't need. But it's academically simple. What's not simple is having the discipline to stay with a system, a trading system, when your emotions are all tied up in it. It almost feels intuitively wrong when you're coming out of the market or into the market, every point to stay with a system. And many times people second guess themselves. And that's where, when you come off the reservation, the system stops to work and you lose money, and it's difficult.
Nick, let's go back to the very beginning, I think, for most investors today, because you mentioned that your idea with this book was to try and introduce people in kind of a more easier to understand way. Let's talk about something that right at the root level, why invest? I mean, obviously, everyone can see right now the landscape in terms of jobs is changing. You could argue technology's arbing away jobs. There's just less of a need for people. The idea of a pension pretty much only exists in the public sector, and that's probably going to change. And then clearly, we've seen from a buy and hold perspective, the S&P has cratered over 50% twice in the last 13, 14 years. The NASDAQ took a severe dent. I can't imagine the Japanese people, after looking at the Nikkei since 89, still believe in buy and hold. So why should somebody invest? Why today? And let's just start ground level, and we're going to work back because I've got a ton of notes to go through with you on this. Why invest?
Well, as we know, I mean, as you've described many of the problems, we have a world that's become, it's moving at a faster pace. Innovation is becoming increasingly a major driver. It's difficult for a person throughout their career to stay current, to stay, it's likely that, and there are all kinds of statistics that support this, that you're going to have more career changes or more job changes today than you would have maybe 20 years ago or 30 years ago. As we know, in the private sector, and this is beginning to happen in the public sector, they're pushing the retirement investment responsibilities onto the individual and away from the company. So whether it be Bank of America or General Motors or some of the largest corporations in America, they're saying we're going to create a 401k plan and get rid of the pension plan. And it seems to me like the days of firemen working to age 50 and then getting guaranteed pay till death that's a finite number of days before that gets cut, and that's going to be true across the board. And so we're being forced as a society to live in a more uncertain world where basically we have less visibility on our career earnings and much less visibility on sources of income in retirement. And as a result, we need to basically make our money that we do save work harder for us, because we're going to rely on that more to support ourselves when we don't have work as we age. And so that's the primary driver. And the difficult part is we're tying that together with a problem that sort of an awakening. From 1982 till 2000, the market went up. It basically doubled every 5 years, and it made us very stock-centric. And by the year 2000, people were convinced that double-digit returns in the stock market were very commonplace. That should be expected. And then, as you say, for the next 12 years, what happened was the growth that everyone assumed was there wasn't, and the risks that people had not realized were all there. And so we had a reversal of the risk-reward sort of dynamic. And here we are today in 2013 with people thinking that risk is very elevated and reward is very diminished. And it might be, let's say, too much, the pendulum's gone too far in that direction. But in any event, what we do know is that the market can go through very, very long periods of time without net appreciation. And so you have that dynamic, which is you can't just dump your money blindly in stocks and get a 7% guaranteed annual rate of return. That's not what's happening. And on top of it, the requirement to get some kind of return out of your investment portfolio is rising. The other problem that we've got, which is the bond problem, which is that bonds, interest rates peaked in 1981 and went all the way down to an all-time low in 2012. And we're probably in a time of secular rising interest rates. The Federal Reserve in March of this year put out a forecast of interest rates, and it shows that interest rates go from roughly I'm talking about the 10-year Treasury rate, about 2.7% currently, to around 5% in 2017. That, as we know, interest rates are inversely related to bond value. So rising rates between now and 2017 is going to make bonds a difficult investment. So we have a problem with bonds in that interest rates are rising, and we have a problem with stocks, which is that for 12 to 13 years, they really haven't appreciated much. If you take the net appreciation from 2000 till now, it's about 10%. It's really not that much. And yet on top of it, to compound the matter, we have a work life that's less stable and a retirement income source that's less visible. And so we need to do something about this, which is we need to work more actively to make sure that we do build earnings and avoid major loss.
Well, you bring up uncertainty, and I don't think you're saying, and your book doesn't say this, but none of us can predict tomorrow. But I think in your writing, it comes clearly through that the idea of uncertainty. And it's interesting you bring up interest rates, because I think if we all kind of instinctively know that if rates go back up, the other shoe is going to drop, which is the elevated stock market prices right now. So there's no easy way out to just sit back. And I think, as I mentioned in the beginning of this podcast, I mentioned the two professors receiving Nobel Prizes, and the committee actually announced in their announcement, they said, we kind of know this is contradictory because we're giving one Nobel Prize to somebody who says there's bubbles, there's booms, there's busts, and emotions play a huge role. And then we're giving the Nobel Prize to Eugene Fama, who basically says everything's reflected in the market. And even Fama has come out and said after the crisis in '08, he said, well, that's a perfectly good example of the efficient markets hypothesis. That worked exactly as we expected. I don't think you or I would both agree with that calculation, but this is what we're facing. We're facing this situation of very much new uncertainty, nonstop. But you would have some people like Fama would say, hey, stock market's at all-time highs. Nick, why do we need to listen to you? Everything's looking good. The Fed's taking care of us. Why do we need to listen to Nick?
Okay, well, it's basically this. Fama could be exactly right. I mean, well, actually, just put it this way. But just at some point, it does work to think about common sense.
That's common sense. Come on now.
No, I'm serious. I hate to break it to this, but if prices are high, it might make a difference on your return versus when prices are low. One of the most experienced people who started the American Investors Fund, he said the way you want it to the best way to create a successful mutual fund is to start the fund at a market low. Now, that doesn't say it all. We ran into an investor who had put his money with a very poor performing fund, but he said, I have no complaints. I put all my money in the fund in 2003. Okay, that was a market low. If you had invested all your money in 2009, today you'd be saying, I don't really see any problem with the market. It's been going straight up. So if that doesn't tell you that market timing has something to do with how investors fare, I don't know what does. But the reason why we have to pay attention is because none of us know. Pharma, Nick Atkeson, and all the other guys that line up, we actually really don't know the future. That we could have started a secular bull market, much like 1982 to 2000. In fact, 2009 could have been the low, and we might have 15 to 20 more years of basically straight up to enjoy. On the other hand, another way to look at it would be to say these secular bear markets tend to last as much as 20 to 25 years, and we're only into this for 13 years, and we're at the high end of the channel, and we could go straight back down. The truth of the matter is, my ability to tell you that over the long term is no better than your own ability to tell you that. We just don't know. So what we have to do is, before we jump into stocks, we need to have a plan in place to say, hey, in case this isn't a good market, in case this is the high of the channel and we need to get out, we need to have a plan for getting us out before we're down half or 50 or more percent. So what we're talking about is trying to avoid the major disaster. If we avoid that and then we get back in, we're fine. And if we have this plan in place before we buy, then we can buy today with confidence. And if we buy today with confidence that we have a plan for getting out in case it really is bad, we're going to enjoy the benefits if it's good, if that makes sense.
Yeah. One of the areas that you go in the book, and a great section I recommend just to read this alone, because it refreshed my memory, because I do remember some of the chaos around his managing of the Magellan Fund. This would be Jeff Vinnick, who took over after Peter Lynch at Fidelity for the Magellan Fund. And he had kind of a rocky ride there. And essentially, the rocky ride came from him looking to have a more active approach to managing the portfolio, and to not just essentially, as you describe it, be a closet indexer. At least Vanguard says, hey, you are getting nothing from us except average. But a lot of mutual funds out there pretend that they are more than average. And your story with Jeff Vinnick on how he went through the Fidelity process and came out on the other side is quite telling. It's really, really worth the read. It's a nice reminder.
Well, it talks about what drives finance in this country, and it's not retail investors that drive finance, it's institutions. And institutions make their own asset allocation decisions, and they do them pretty actively, and they feel very comfortable with that kind of decision. And when I say asset allocation, institutions are deciding between bonds, stocks. In stocks, they're deciding between small, mid, and large cap. They're deciding between value and growth. They decide. They look at commodities. They look at currencies. They look at all kinds of alternative investments, real estate, whatever, and they make an asset allocation decision. And like I say, they have methodologies for doing this, and they feel comfortable with that. As a result, equity money management in this country, particularly in mutual funds, even if it's active, is not designed to take you out of the asset class. And the reason for that is that the mutual fund manager is not responsible for that asset allocation decision. If you gave money to a mutual fund, their job is to do the best job they can in the asset class, meaning in stocks, particularly if we're talking about a stock mutual fund. The point is, if you put all your money in a stock mutual fund that you thought was actively managed and it stayed 100% invested and the market goes down 50%, that manager is doing his job even though you lost half your money. The responsibility for making that asset allocation decision is upon the individual. Unfortunately, retail investors don't have the tools to make good, active asset allocation decisions other than rebalancing at the end of a period. But they don't have the tools to be proactive and make dynamic management decisions. How do you make these basic asset allocation decisions in a responsible way, non-emotionally, systematically, in a disciplined manner that gives you a chance of succeeding and being in stocks when you should be in stocks and out of stocks? Because we know for the most part, your index fund certainly won't make that decision, and your active mutual fund manager certainly won't make that decision for you.
Yeah, because if you get a manager that goes against the grain, and I bring up Vinnick again, because you got a great example in the book where you talked about in 1995, he produced 36.8%, the S&P produced 37.6%, and clients complained because he didn't at least match or beat the S&P, where the reality was he was probably making decisions that if something unforeseen would have happened, he would have at least had a chance to get more of the upside. So the fact that he just didn't even that he was very, very close to the average and people complained, they completely missed the idea that he was setting the probabilities up and the opportunities that if something else happened, he would be there, whereas his competitors that were the closet index funds that you refer to were not doing that.
That's correct. In the epilogue of that story that's in the book is that basically Vinnick gets fired from Fidelity from being a bit too aggressive. He made some very, very major asset allocation decisions away from equities, and he made them early. And so his crime was he was a little early. He showed a bit of underperformance, and Fidelity said, we don't need. So I was just saying that the epilogue of that story, I don't know where I got cut off, but the epilogue was that they fired Vinnick. Fidelity fired Vinnick because basically he had made his asset allocations away from equity early, and then had people just waited. Had they kept him on, he would have shown great outperformance. So rather than being at Fidelity to show that outperformance, he went off and started a multi-billion-dollar hedge fund that had great returns for his investors and made him extraordinarily wealthy.
It is interesting, and this requires investors though to look under the hood, so to speak. And I think this is what I've tried to do in my career. I can see you doing in your career, but we've had a situation for a long time, and I'm sure even after the quote, perhaps the lows of early 2009, perhaps not. I'm sure a lot of people are sitting back right now and saying, "Hey, why do I need to do all this? Look how much the S&P has come up. It's at all-time highs," and it's getting people to look under the hood. And one of the things you do go into in your book, and I'd love for you to talk about this some, is the idea of tail risk, or people have probably heard the parlance of a black swan. Maybe you could discuss the idea of tail risk from your perspective.
Okay, yeah. So on my perspective, basically what we're talking about is when people look at a distribution of outcomes, they assume some if you do something 1,000 times, what will be the set of outcomes? And in finance, they've applied what they call a normal distribution, which is an evenly centered distribution of outcomes around a midpoint with half the outcomes being positive and half the outcomes being negative. And in the book, we go into what 1 standard deviation, 2 standard deviation, 3 standard deviation means. And in finance, standard deviation is basically the word for risk. In other words, how big can the variance be around the mean? And based on the size of variance, that would be determined how risky the asset is. In stocks, it's considered to have an annual variance of standard deviation of about 20% historically, which is pretty high relative to a historic standard deviation for bonds of about 4%. Okay, so the thing about a normal distribution is it can be sort of comforting that, hey, some years I'll be down and some years I'll be up, and they'll be equally distributed, but the mean of this set of outcomes is a plus 7%, something like that. But what's disturbing is when you realize, hey, in real life, the outcomes in the stock market haven't fallen evenly on the upside and the downside. In fact, the downside events have occurred more frequently than normal distribution would have implied, and they've been much more severe. And there are lots of examples of this in the book we give that are, for instance, the collapse of long-term capital, where they describe financial markets going through something that could only happen once every trillion years, or, something that's beyond the life term of the Big Bang or the universe or the Earth, and kind of crazy numbers. But basically, over the last 30 years, the market has had sort of a significant collapse about once every 6 years on average. And that's if you had said that in the year 2000, people would have looked at you like you were from Mars. The market basically went up almost all the time between 82 and 2000 with some short derivations. And when the market collapsed, for instance, in the Asian stock crisis of 1998, it recovered very, very fast. It was a matter of single-digit months. And so in these bullish phases, these strong downturns are very short-lived, and you'd make a mistake to sell at any point. Just buy and hold right through it. And actually, 2013 is a mini event like that. In June, we had a very sharp pullback, but you just held through it. You've been well off. August was like that. And just right now with the debt ceiling negotiation, it's confusing. There's a lot of stuff on TV that's upsetting. Potentially the United States will default, which could be a major catastrophic event for markets potentially. And so there's a lot of worry, and it can cause you to sort of overtrade and maybe miss a longer term thing, which is it might not matter that much, frankly, and the markets are on their way to a higher place in the near term. But in any event, to get back to the question, which is negative tail risk, it means that the set of probabilities or the set of outcomes aren't occurring in an equally positive and negative way. There are more negatives that are occurring. They're happening more frequently, and they're more severe. And this book is all about preventing those major losses, and that's how you win.
So I saw a comment today from somebody. I made the comment about Black Swan, I think, on my Facebook, and some young guy, analyst, investor, I'm not sure what, he immediately came on and said, well, there's no such thing. As long as I can do my research, I can stay one step ahead, and there's no such thing as a black swan, because if you do the right research, you can always know. And boy, I think that's a frightening view that I think somebody has in 2013.
Well, that to me says the guy must be about 22 years old or younger. Maybe 5 years old younger. As we know, the world's a complex place. It's difficult to model. It's somewhat like the weather. The weather is complex. They said that global warming was going to cause more storms, more hurricanes, because basically water temperature and air conditions and these things would, as the globe heated, would be conducive to hurricanes. Well, it turns out that there haven't been very many hurricanes lately, and it turns out that the hotter climate has caused a drier air condition and has actually been complex enough to actually diminish the amount of hurricanes this year. So no matter how well you think you have it pegged, the world is a complex place, and it's very hard to predict outcomes. I mean, one outcome that I think that is difficult to predict is what happens when the U.S. potentially defaults on its debt. It's from a logical standpoint, it would be incredibly disruptive to take the risk-free asset, the short-term U.S. Treasury, and make it risky, because almost all other financial instruments are based on have some element of valuation based on the price of a risk-free asset. And all of a sudden, the rate of that goes crazy. It's going to be very confusing how to price all other financial assets. And on top of it, there could be all kinds of liquidity issues. But that's sort of the surfacey obvious statement. It could be that it makes no difference at all. It's just a very complex world, and it's hard to know all in advance.
As you bring that up, I think what's interesting about the debt ceiling debate and defaulting is everyone's watching it in real time and imagining, okay, when the date hits, it's all going to go down. Boom. The other issue that people aren't thinking about is that perhaps there's one political persuasion, and I'm not making a judgment here, but perhaps one side of the equation believes that if we don't solve this now, it will be the lurking black swan that brings all of the things that people are imagining that could happen that are bad with a default when we least expect it, right out of the blue, because the situation has got so untenable. So it's really interesting. We're watching it in real time, but it might be the point where we're least expecting it, where it all happens.
Yeah, I think that's a great point. And again, it just gets back to, it's fun to speculate about these things, but when it comes to managing your own money through this type of a thing, it's important to have some kind of systematic way to do that. And, again, we can, in our own minds, conjure up all kinds of theories about things. But what the book is trying to do is give people a disciplined way to make a good evaluation of what the market prices are telling them, and then go with that. Just by the way, it's kind of just a sort of a point of the moment, is that here we are on October 15th, 2 days in front of the deadline, and the Russell 2000 IWM ETF hit an all-time high yesterday, and so did the S&P 400, the mid-cap stocks, hit an all-time high.
Yeah.
Who would have thought?
Let me, we've brought the word up several times, systematic. And I think a lot of investors, maybe even experienced ones, still want to imagine the idea of their gut, their intuition playing a role. But when it comes to managing your portfolio, we're talking numbers, we're talking precision, we're talking if you're going to have a strategy that says, I'm only willing to lose X percent, then there has to be a strategy that systematically keeps you to that. Because if you get to the point where you say, okay, I'm now at the point where I was willing to lose only X percent, but hold on, if I just let it go down a little bit more and I hold on, the market will bounce back and come my way. I think that's part of the thought process. So the idea of taking your loss, of walking away from the table, licking your wounds and coming back to play for another day, this gets into behavioral finance 101. This is not the natural human condition.
That's exactly right. In finance and in investing, your emotions are often your biggest enemy. When we used to work at a place called Susquehanna, which was founded by professional poker players, and everyone in the firm was required to play poker extensively. And then there was a firm-wide tournament that led to a final table in Philadelphia in the Bala Kinwood office, and then the winner of that would go on to the World Series of Poker. And so it was a pretty serious tournament, but basically the message there was, you play the odds. It's not about bluffs and, the guy's got a tick in his left eye or anything. It's what do the cards say? What are the odds? And if I play this game 1,000 times, yes, on one bet, I could be wrong, but if I play it 1,000 times, the majority of the times I'm going to win. And that's what we're trying to do here with whether it's blackjack or buying and selling stocks. We're going to use a systematic approach, which is going to, on average, make us a winner. And more importantly, maybe a better way of phrasing it is to say it's basically giving us an insurance against having a catastrophic loss, because catastrophic losses can be life-changing. So what we're doing is we're layering on an insurance piece in our stock investing that prevents against catastrophic loss. and allows us to always be there and in a position to make gains.
As we wrap up, I want to go to the most important theme and let you kind of expand some, which is, and we've talked about this already, but I think it's just to dig in and come up from multiple perspectives. But loss avoidance is the top priority. The idea really is to be successful, control how much you could lose on the downside. Don't start having dreams of sugar plum fairies and how much you could make. And that is so different than what you find in the average investor, the average university curriculum, because it gets so focused on the upside when the reality is if you can just take care of making sure you have capital, you have chips to play the game, don't worry about the upside. Have the good process, have your plan, have your systematic plan in place, but focus on how much you can lose. And I think that would be summing up nicely where you really want it to go with your book.
Yeah, I couldn't have said it better myself. It's taking the most investing, when you listen to people talk about it, many people will come to you and say, oh, I've got 3 great ideas. Here's a stock that I think can double in the next year. Here's a stock that's going to go up 5-fold. It's, it always starts with, here's the millions of dollars. Here's a huge amount of money. Here's the crazy percentage win you can get by buying this or that. Our philosophy is exactly the opposite. It's, let's start with how much might we lose and how do we prevent having that loss? And then the wins will take care of themselves. So if we take out the losing side, we're going to win by not losing. And I think that's, like I say, I don't think you could have said it any better.
I got one more question for you if you got a moment.
Yeah.
How did you get started? What were you doing when you were a 13-year-old guy?
Well, it's funny, I've always had an interest in finance. I started out, when I was 13, I probably didn't have an interest in finance, or didn't know I had an interest in finance, but I probably like numbers. And, but my first job, I was an accountant at Price Waterhouse. So I kind of had that leaning. I went to Stanford Business School. And my first job, I kind of liked stuff. I wanted to do finance, but I wanted to be involved in, real stuff. So I got involved in a leasing company for railroad equipment and tractor trailers, aircraft, containers. So we were an operating lease company, but my job was all with the chief financial officer, and it was figuring out the finance of operating leasing. So I've always been in the finance world. In the San Francisco Bay Area, in the early mid 80s, let's say, the economy was actually fairly broad. There was Chevron, there was Southern Pacific Railroad. The downtown financial district was filled with operating companies doing, let's say, tangible things that everybody could understand. This company, ran railroads. This company ran shipping containers. This one had shipping lines. This one, ran whatever. So, but that changed as the Silicon Valley emerged. What San Francisco's economy really became driven by was innovation down in Silicon Valley, and then the financing of that innovation through the investment banks of Montgomery Securities, Hambrick and Quist, and Robertson Stevens. In other words, San Francisco was all about financing the innovation in Silicon Valley. And as I looked at it, my background was finance, not computer science. And so I migrated into providing fundamental research services to hedge funds and mutual funds through Montgomery Securities, where it was all about we have better research about Inktomi than anybody else, or we know phone.com better than anybody else, and we're going to tell you about this company, and you're going to understand it fundamentally, and you're going to buy this stock, and it's going to make a difference in your portfolio. And that actually in the mid-1990s made a ton of sense because mutual funds at that time were still very much in the growth mode. I mean, an MFS might have been, let's say, 100 or 200 billion. Well, or maybe even 150, 100 billion, let's say. Well, many of these companies now are $2 trillion. So the size of the money in mutual funds greatly expanded. That was one piece where it became harder and harder to make a difference with owning a single stock or 10 great stocks or 20. These companies had to own the entire market, and they were managing so much money, stock picking almost became irrelevant. The other thing that helped make stock picking irrelevant was the use of ETFs, where big chunks of the market trade in blocks because it's so much easier. If you want exposure to technology stocks, you don't go pick 20 technology stocks. You buy the S&P or the SPDR technology sector as an ETF. And so the market's has been turned into a bunch of ETFs versus single equities, and that took that out. And then also a bunch of issues regarding regulation, full disclosure, and other changes that occurred as a result of the technology bubble burst that made research analysts have much less proprietary information about specific companies. So the value of the research that the investment banks were offering went way, way down. They just didn't have the same kind of information. So with this, we migrated from deep fundamental company-specific analysis into what are the price signals the market's giving us, and how do we work with those? And it turned out that's always been there, but it's become even more powerful today, given the structure of the market, given computerized trading, given ETFs, given the lack of quality fundamental research from investment banks, etc.
I think your accounting background, anyone who comes from a background in this day and age that wants to be involved in trading, investing, and has the thought process of numbers and organization has a leg up. So I often hear people say, well, you need to find the investing strategy that fits your personality. Well, let me tell you, if your personality doesn't fit numbers and doesn't fit organization, I don't know what strategy is going to work for you. Your personality is going to have to adopt or adapt to what the real world is. And the real world is organization and numbers. And so if your personality is like you want to be a cowboy, you might as well just give your money away to somebody right now before you lose it.
Yeah, well, much of what we talk about in this book is naturally appealing to engineers who like to study things and quantify things and have a systematic, disciplined approach. For those who, as you say, don't have any feeling for that and really are not interested in that and don't think about the world in that way, that's not how their brains work, you do have Delta Investment Management. We do it for people and separately managed accounts.
I think there was a sales pitch right there. I think someone's...
That was too fat a pitch. I had to go with that.
Okay, as you say that, let's wrap up. Let me let you tell the audience, if they want to find out more about you, Nick, where can they go?
Okay, so the best place to go is our website, which is www.deltaim.com. Delta, and the IM stands for investment management, but it's deltaindiamary.com. And there on the programs page, you can see each of our tactical strategies, which are using, like I say, an active, systematic, disciplined approach to the market. And you can see the audited results. And so we're very forward with our results. We want to show people the results. Because if we're going to talk about doing this and we're going to really say this is the way to do it, we better have something to show for it. And we do, and we put it right on the website, and we encourage people to look at that. And then they can always just call us, and the number is 415-249-6337.
Nick, it's been fun. I enjoyed it. I really love the example, and I mentioned in the podcast, but I really love the example with Vinnick because it was a good reminder to think back to that period, because the press at that point in time really probably, he didn't win on the press, but and the historical legacy, I think for those that are curious, they can find out who won.
Exactly. Yeah. And it's also Peter Lynch. It's kind of an interesting story about him, who spent a lot of his time talking about just invest in what you know, go out to your neighborhood. And meanwhile, he owns 1,400 stocks on average. In other words, the broad market. And whether he knew Dunkin' Donuts or some other company, it was irrelevant. He owned the market. The market was going up.
Yeah. Nick, hopefully we can talk again in the future, and I appreciate your time today.
Okay. Thank you so much.
Take care. I see a time when those awake will understand how to make money in up, down, and surprise markets. Whether new trader or experienced, college student or financial advisor, protecting against a crash or just trying to make a lot of money, trend following offers everyone an answer in uncertain times. To get started immediately, send me an email, michael@covel.com. I will send you the right trend following steps to take along with my free video. But if you want to buy and hold, trust the government and trust Wall Street, this is absolutely not for you.